Welcome to Option Strategies. Recently, the state of California has announced a plan to ban the sales of new gas-powered vehicles, which giving a big push to the electric vehicle industry. So in this video, I want to talk about how I plan to trade Rivian with option. First, let's look at some of the good news. In Q2, Rivian was able to produce 4,401 vehicles and affirmed the forecast to produce 25,000 cars for the full fiscal year. The company also reported 364 million in Q2 sales, which easily beat the 338 million analyst estimates. Besides, Rivian have 98,000 unit pre-order as of June 30th, 2022, which was an 8,000 unit increase in just about 2 months, even after 20% price increase of various EV model on March. Currently, 17 street analysts has an average price target of $52.69, plus 8 of the 17 analysts have a strong buy rating on the stock versus only 1 sell rating. Despite all the good news, the company does face some headwinds. Unfortunately, in Q2, Rivian suffered a net loss of 1.7 billion, about 3 times higher than the same quarter a year ago. The management also cautions the investors that the company may suffer a wider loss for the fiscal year than predicted. Besides of all the competition that the company has to face, some of Rivian EV are not benefit from the new Inflation Reduction Act that require the EV truck cost less than 80,000 and sedans need to be less than 55,000. In terms of technical analysis, Rivian's stock price was in the 3 months of rising channel until the Q2 earning report announcement that brought the stock price back down to the support level of March 15. With all the information, I'm cautiously bullish about Rivian. My assumption is the stock will trade sideways and looking for another breakout. Of course, this is my assumption about the stock, and this is not a trade recommendation. So, how can I trade Rivian now? The option strategy that I want to use is selling a broken wing iron condor. This is the profile or loss. This is a profit or loss profile of the strategy. The trade is set up by selling out of the money call and buy a further out of the money call option. Then selling out of the money put option and buy a further out of the money put option. The put option spread is wider than the call option spread, and the total premium collected is more than the call spread width. In this example, the call spread width is $1, the put spread width is $2, and the premium collected is $1.03. The major benefit of this strategy is I have no risk on the upside, which means I will not lose money if the stock price moves higher than the call option spread that I sell. In the contrary, I'm able to make a small profit. The risk is only on the downside and it is limited. And the maximum profit is if the stock price stay within the short call and the short put option when they expired. However, the maximum profit is limited to the premium that I collected. Thank you for watching, and remember, all trades discussed in this video are not trade recommendation.